Okay, our last video here is going to focus on private financing sources. So we've obviously highlighted several different sources of public financing. Now we're going to shift gears and look at different sources of private financing available to sports team owners that are looking to be more independently finance their sport facilities. And again, keep in mind that there is seemingly a trend towards more private financing right now for multitude of reasons that we mentioned earlier on, whether it's negative public perception for public financing, or team owners simply wanting to have a little bit more freedom and flexibility with the decisions made surrounding the construction of their facilities. There are tax limitations that are making it more difficult to get those public sources of financing. So, for all of those reasons, I think we're starting to see a shift towards more private financing, or at least some combination of public and private financing. So, we're going to highlight several different sources of private financing here. And keep in mind, we don't necessarily have to consider those concepts of equity when we're looking at sources of private financing, right? Because we're no longer talking about public money or tax dollar money being spent. So now these are private sources of funds that the team is securing. All right, so a pretty common source of private financing for team owners is simply securing private investment, whether it's from business friends that they might have, or people that are seeking to invest in the team, or simply going and getting a private bank loan, right? So this is, just like you or I might secure a private loan if we were looking to start a business. Obviously, sports team owners have the ability to do that as well. And actually was doing some searching earlier on the internet and found that JP Morgan Bank actually has an entire subsection of their website allocated to sports team and stadium financing. So you can see that this is big business for them, loaning private dollars to team owners, and obviously they're going to be charging some kind of interest on these loans. So it's certainly good business for them. And for team owners, they probably have relatively good credit. They probably get pretty good rates by using private funds. Okay, a couple of other sources of private financing here. We mentioned private funds and bank loans. Contractually obligated income is another really common source of private financing. And obviously, there's a number of different sources of contractually obligated income available to sports teams. So, this could be anything from, securing a naming rights deal for the new stadium, right? Maybe you secure a new naming rights deal that spans 20 years, and that money is going to be allocated towards financing the stadium, right? That's a pretty common one. Any kind of broadcasting deal that one has with the local community could also be allocated towards private financing. A lot of teams at the professional level will utilize some kind of premium seating. The NFL, for instance, used premium seat licenses for a long time in order to finance facility construction. So, those are all contractually obligated sources of income that the team can then allocate toward building a particular facility. Another source of private financing for professional teams are league funds. So the NFL, for instance, has what they call a G4 loan program, where essentially any team can take out a loan from league funds, right? So it kind of acts like its own bank, right, where they have the ability to take out a loan and then pay it back to the league with pretty low rates of interest. So the Vikings did this with their new stadium. The Rams just did this with their new stadium. So, basically for the league, they see it in their best interest to have teams building and constructing newer, fancier stadiums, right? It looks good for the league as a whole. So they're willing to loan out those funds in order to assist the teams in getting their stadiums or arenas built. Here's an example of a facility that used a lot of private financing in building their facility. So this is Levi Stadium in San Francisco. Believe it might have a new naming rights partner now, but this is the original source of financing list here. You can see bunch of different sources here, but if you highlight the different private sources, so you have a G4 loan that they got from the NFL, you have naming rights revenue that they initially signed with Levi's, and then you have different contractually obligated income that they identified from premium seats, suites, and sponsorships, right? So when you account for those three different sources of private financing, you can see that actually 87% of their financing came from private financing, right? And again, all you do to get that is add up all of the sources of private financing in this case. You see what that is, and then you divide it by the total funding sources, and that gives you a percentage. You're probably going to be asked to do something similar to this at some point, either in a practice case or on an exam. So make sure that you are getting some practice here in identifying, whether or not something is a private or public source of funding. And again, in this case with the 49ers, they were able to rely heavily on private sources of financing. There were also some public sources here, but in terms of the percentage, those accounted for a much smaller percentage than the private sources. Okay, so again, we've identified a number of both public and private sources of financing this week, and I know it's a lot of information, but I do just kind of want to wrap up this conversation by noting that there are some trends that we're seeing in terms of facility financing, and Zeitz mentioned several of these in your textbook, and I think it's important to note that we are seeing trends towards more private financing, right? So more funding that's being directed specifically by the team or those associated with the team. So definitely a shift more towards private financing. And we've obviously highlighted some of the reasons for that in recent years. We're also still seeing a lot of taxes being utilized through this case being made for redevelopment of surrounding areas. So going back to that tax increment financing that we talked about earlier, a lot of teams are still trying to make this case, that if we improve the facility, we can also work to improve the surrounding areas. So still going to continue to see that argument be made and taxes coming from that particular aspect. And then finally, we are starting to see more of this public and private partnership where basically, maybe the public helps finance a facility. So from that point on, they're also involved in the ownership and management of that facility. So that's an important thing to keep in mind, that just because the financing might be partially funded by private financing, if there's any public funding involved, then most likely that public entity is going to want some say in the day-to-day of that facility. So a lot of times what you'll see is even if a public facility is owned by the city, they'll tend to give a lot of operating power to the team. Essentially they don't want to have to worry about the day-to-day management of that facility. We've seen that here locally for several years now with the Grossinger Arena, where there's a lot of sort of changing of third-party management companies with that facility because essentially the city doesn't want to have to manage it. But definitely seeing more of these public and private partnerships pop up. Obviously, there's a lot of issues that exist and some potentially conflicting goals that exist, right? Obviously, have to sort out who is technically the owner of the facility and what that means in terms of how revenue is allocated. There are a number of other issues here that your textbook highlights that I won't go into, but keep in mind that one of the sort of subsets of having a public-private financing arrangement is that there's likely going to be this ongoing public-private partnership. So potentially another reason for sports teams to look at how they can privately finance their facilities if they want to avoid being in this public-private partnership. Okay, that's all I have here on our unit on facility financing. Again, I think the keys here in terms of takeaways are sort of understanding the difference between public and private financing, being able to identify a source and whether or not it's public or private, and also in terms of acknowledging public sources of financing, being able to answer that question about equity, right? And whether or not a particular source of financing fulfills that benefit principle. Okay, so everyone have a great week.